On your screen, you can see the all-important investment disclaimer for you to read. I'll summarize it for you very quickly because the highlights are that we don't offer advice. Nothing that you hear tonight is a recommendation or endorsement. And if you are not sure about the suitability of investment, then you should please seek qualified independent financial advice. Now that's it for the housekeeping. So let's crack on with the show, as I appreciate already that the clock is ticking. So I'm going to start off just by looking at investing for income 2021 and beyond, predominantly from a UK equity perspective. So I'm going to try and keep it fairly high level so I don't tread too closely on Simon's patch in particular when he's giving his presentation about Merchants Investment Trust later on. Another disclaimer, just very quickly have a look at that, but again, the same key themes about advice and the absence thereof, recommendations and endorsements and the absence thereof, and again, the suitability of investments. And if you're unsure at all, then please do seek independent financial advice. So what I'm going to talk about, I'm going to quickly talk about the global backdrop for income and particularly equity income. Then look at what happened last year, which is the bit I'm really good at because I can read the newspapers as well as everybody else. Then I look at what's been happening so far with dividend payments this year and what analysts and consensus expect going forward. Then just a few key tests for you to help you do your own personal research. And then just a few conclusions about equity income and equity markets more broadly. So the global backdrop for equity income, well, you know, you've heard the story of all that saying TINA, T-I-N-A. There is no alternative, and you can understand why some investors have felt that they've been herded towards stock markets and perhaps been taking on more equity exposure than they would have maybe historically done so. Because let's face it, cash in the bank hasn't really offered you an awful lot for an awfully long time. In fact, the thick end of 15 years or so since the global 13, 14, 15 years since the global financial crisis. We can see here that the US Federal Reserve managed to squeeze interest rates all the way up to 2.5% in 2019, went to very quickly recant when the pandemic hit, and then the US went into a deep recession. The UK, well, interest rates haven't gone above 1% for well over a decade. And in fact, in Japan, they've been negative for most of the last 5 years. So cash in the bank really hasn't brought you an awful lot of joy in nominal terms. And once you adjust for the little bit of inflation that's been in the system, and it's only been a little bit, your returns have been further eroded. So one asset class option available to any investor, sticking in the bank, really hasn't looked terribly attractive, and that has posed a bit of a conundrum. That's then been reflected in global bond yields, because again, why have central banks been running low interest rate and quantitative easing programs? Well, they want to keep borrowing costs low, not just for governments as it happens, but again, because the government bond yield is the reference base, that helps drag down the yield on corporate bonds and debt for consumers as well. But as you can see here again, we've had some historically very low government bond yields over the last 5 years and indeed beyond that. I guess what's interesting is you are seeing a little bit of an uptick in the past 3, 6, 9 months, because you start to see concerns about inflation creep into the system, relief that maybe there's an economic recovery coming in the wake of the pandemic, but now concern that central banks have thrown so much money at it for record low interest rates and quantitative easing, and governments have thrown so much money at it through fiscal stimulus and furlough schemes and other tools, that maybe they were going to get a rip-roaring economic upturn, and actually inflation could result as you get supply side destruction, as you get supply chain bottlenecks, as you get wage growth increases even. And so bond yields have begun to tick up, but they're still pretty low. And again, relative to inflation, they're still pretty low. The UK 10-year gilt yield of around 0.9% looks pretty sick right now compared to an inflation rate of 1.5%. If you think that that inflation rate will persist for the next 10 years, then you're locking in a 0.6% per annum loss pretty much straight off. So again, that's not looked terribly exciting, and investors have therefore had to reach further for yield, take on more risk than perhaps would have done normally to try and find some income for themselves. At least we are seeing a little bit of change in momentum, as I've said. You're seeing a few more interest rate increases now. Generally so far in emerging markets, Russia, Brazil, Turkey, they're starting to see some inflationary pressures that they're concerned about. But overall, we're still seeing a pretty low number of rate hikes compared to what we're seeing even 3 or 4 years ago. And again, we're still at historically pretty much very low interest rates, more or less all the way around the world. And what you can say is that slight change we've had in bond yields has meant there's been some violent movement in bond prices. Remember that just like a share price, the higher the price goes, the lower the yield is, and vice versa. So if you've got a very, very low bond yield, and then the price starts to move against you, you quickly suffer some fairly nasty capital losses, or at least on paper, relative to the bond that you're getting. So if you look here on the right-hand side, you've seen some quite violent price moves, 10, 12, 15%, particularly in long-dated government bonds, that have therefore wiped out a very, very long time's worth of bond yields. So that's why some people have been arguing for some time that bonds represent return-free risk, because the price could go against you and eat up the yield that you're trying to earn, and that's before you even start worrying about inflation. So that's been a big backdrop to the Tina argument that equities and indeed other asset classes, such as the one that Phil's going to talk about, are providing the income that some investors crave, bring money into their savings pot, help them meet their bills on a regular basis. Now, last year was nevertheless, for those income seekers, not an awful lot of fun. Now, I know it wasn't a lot of fun for nearly everybody for a multitude of reasons more important than just share prices and dividends, but nevertheless, from a narrow perspective of investment portfolios, income seekers felt a lot of pain as well. As we went into the pandemic, we went into lockdowns, the economy, global economy tips over into recession. Companies were very, very quick to hunker down, plan for the worst, hope for the best, and try and save cash and preserve cash. And a quick way of doing that was, frankly, cutting their dividends. So when we did this event almost a year ago to the week, though I do thank my colleagues for not holding it on my wedding anniversary this year, which is in a week's time, we were remarkably actually already coming through the worst of the dividend cuts. Though it didn't feel like it. You can see the month by month tally here, and it actually came out at £48 billion across the bulk of the UK, or certainly the numbers that we've been able to put together, with a lot of that coming from the FTSE 100, where more than half of the index took the knife to its dividend payment in one way, shape or form, cancelling it altogether, cutting it, postponing it, or deferring it. But at least the good news was toward the end of the year that began to trickle off a little bit, but it really wasn't an awful lot of fun at all. And at one stage forecast that the FTSE 100 will be offering 5-6% dividend yields. Well, that didn't actually prove to be a realistic expectation, as companies look to preserve cash by slashing their dividends. Now, why did that happen? Well, the pandemic is obviously the most obvious example, but you could have argued that it was maybe on the cards anyway, because FTSE 100 net indebtedness had gone up since the global financial crisis. Firms had been adding perhaps to their debt piles by buying back stock and a little bit of financial engineering. Earnings cover, one metric for dividends, had begun to get historically quite thin at 1.4 to 1.5 times, when it really needed to be 2 times. So given that backdrop, an ordinary recession, common and garden one, may have seen some companies' dividends come under pressure. And then, of course, we got the worst recession in 3 centuries. So that was more than enough to tip a lot of companies over the edge. The good news is, picture's looking a little bit brighter in 2021, even if the weather's been filthy recently. So the total of UK dividends paid or restored already this year is some £36 billion, and that compares to barely 4 billion of cuts. And on a monthly basis, I think we had one company announcing a cut year on year in April, and that was BP. And that was hardly a surprise because they announced the cut initially about a year ago. And then there was one in April. I think there's been one so far in May. So again, I think companies now, touch wood, feel that they're through the worst. They did plan for the worst. They hope for the best, and they maybe haven't got things quite as bad as they expected. And through cost cutting, government support, cash preservation, they now feel they're coming out the other side, helped again by vaccination programs, by fiscal stimulus and monetary stimulus. So they're starting to be, frankly, a bit more free and easy with the cash, and dividends are starting to come through pretty thick and fast. So as a result, this is the aggregate consensus for the FTSE 100. So I've taken all FTSE 100 companies, looked at the analyst forecast for dividend per share, looked at the number of shares in issue, added the whole lot together. There's an expectation of around a 20% plus increase in FTSE 100 dividend payments this year. Intriguingly, a more modest one next year, low single digits. So I think there's still some uncertainty of the economic outlook for 2022 and beyond, but there's certainly a strong sense that we're bouncing back, and that still isn't quite enough to get dividends back to their 2018 peak of around 83 or 84 billion pounds. But nevertheless, That's still enough to give a yield of more than 4% on the FTSE 100, which again beats what you're getting on cash, beats what you're getting from government bonds, for example, and at the moment at least is beating inflation and helping you preserve your wealth in real inflation adjusted terms. So again, there is that case from an income perspective that UK equities may be one thing to consider as part of a balanced portfolio. Now, also just a sign of real confidence, and this is about as much a matter of philosophical debate as financial. You've actually seen 30 UK listed firms announce share buybacks this year. Now, they generally only do that when they're feeling really pretty confident about life. And around, I think, 11 FTSE 100 firms have now announced just over £8 billion worth of Vodafone have topped it up this week, £8 billion worth of buybacks. That is more money in the shareholders' kitty. It may be a matter of your personal tax situation, how your investments are structured, or your investment philosophy, whether you prefer buybacks or dividends. And Simon may have something to say about that, for example. But I guess you can say potentially it's a sign of corporate confidence. I certainly wouldn't have predicted a year ago the companies would be so quick to return cash to shareholders in this fashion, given that in some cases it maybe got companies into trouble in the first place when it came to cutting their dividends. But nevertheless, some people view that as a sign of confidence. Some may be a little bit more cynical and view it as a sign of overconfidence. But at least, again, it suggests the worst is out of the way, economically speaking. Now, the one thing that is interesting about the FTSE 100 is its mix. Now, on paper, that 4 to 5% dividend yield really does sound pretty plump and juicy, but you've got to look at its provenance. And I think for the first time, pretty much ever, according to my spreadsheet, mining is the biggest contributory sector. It's normally been financials or oil and gas, but it's mining right now. And there's a fairly solid, stodgy element there from consumer staples, Unilever, Diageo, but also the big tobacco companies. So you've got to be aware of the mix in terms of how cyclical or reliable the cash flows are that fund those dividends, because mining and oil and gas can be pretty up and down, and banks aren't loving a low interest rate environment. And consumer staples, there's an ESG angle there, an environmental, social and governance angle. Are you happy to own tobacco stocks? Maybe you could say the same about healthcare stock, about oil and gas stocks as well. So yes, it's all very well saying, gosh, isn't the FTSE 100 looking good on the dividend yield basis? But you need to know which companies are paying the dividends, and those are the key sectors that you've got to watch. Now, in a strong economic recovery and inflationary environment, that's not a bad mix, actually. But in an environment where you get a deflationary shock, or you get a very sluggish growth, it might not be quite so clever. So again, your macro view may influence your thinking here. And again, just in terms of the mix, those are the 10 biggest forecast payers in cash terms this year. And there you go. So that if you really want to dig into the FTSE 100, these are the 10 companies you've really got to be confident of, particularly if you're doing this through, say, a tracker fund or a passive fund. You really need to be confident in these names, because as you can see on the right-hand side, the bare earnings cover for the dividends isn't necessarily as high as you would like. 2 times or higher is always offers a bit more comfort, even allowing for the fact that some of these companies are pretty steady Eddie and pretty reliable. Now, the other thing to bear in mind is that a lot of those sectors are very unpopular. Oil and gas, I think it's probably only tobacco and coal that you can argue are the least popular sectors. People worried about whether the oil price recovery will last or not. But again, taking Sir John Templeton's maxim on board, people are always asking whether the outlook's good, but that's the wrong question. The right question is, where's the outlook most miserable? Because what he means by that is that's where the value is, either in terms of earnings or dividend yield. And some of those unloved sectors like oil and tobacco, you may have to hold your nose and have a look at them if you run some strong ESG screens, but they are very unloved and may therefore be potentially undervalued on an earnings or a yield basis. Because that's a decision that only you can take for yourselves, having done your own research, or once having got a fund manager to do the research and thinking for you. So very quickly, key tests on how to tell whether a dividend is safe or not. Earnings cover is one. That's earnings per share divided by dividend per share on a forecast basis. You can do it 1 year forwards if you want, but I think if you want to be really safe, maybe look at it on a 5 or 10 year average basis, because then you can see how cyclical the company's earnings are. You can be fooled into thinking a dividend is safe when it's because it's at the peak of the cycle and things are looking pretty good. What you need to do is see how bad things can get when things go wrong and the cycle turns down, to see how much safety and defensive ballast you have there. Free cash flow cover I'll take you through in a moment. That's a slightly more detailed test. And again, you ideally want to do it over a period of time, and you want to do it in a 3D context. You want to take profit and loss account, cash flow, and balance sheet all together. Balance sheet is very important. Net debt, work that out. But yes, look, is there a pension deficit? Are there leases? Are there even contingent liabilities relating to past acquisitions or lawsuits, for example? All of those could be cash out. BT has been a classic example of a stock with a lot of debt and a big pension liability that's made it very hard for it to sustain its dividend payments, given it was fighting on many other regulatory and competitive fronts, and its dividend went through Burton last year as a result. And you also need to look at interest cover. How much does operating profit plus interest income cover the interest bill? Because if that cover's pretty thin and then profits go down, you're going to be struggling to pay your interest bill, and that means your dividend could well be cut. So you need to look at all three parts of the accounts together, and if anything, start with the balance sheet and do the cash flow and then the P&L, whereas most people do it the other way around. Imperial Brands, this is just an example again of an unloved stock, cut its dividend last year. You've had a torrid period of profit warnings, dividend cuts, executive change, rejigs of strategies, but funnily enough, free cash flow cover for the dividend actually hasn't been that bad. I wouldn't want to say that they didn't need to cut the dividend, but they would have got away with it if they'd really fancied it. But even now, you're getting a dividend yield of 7 or 8% for a very unloved stock in a very unloved industry. Again, ESG investors will literally hold their nose and just turn away. But a very rigorous check like that, adjusting operating profit for depreciation, amortization, changing working capital and capex, and then knocking off key bills, tax, interest, pension contributions, leases, things that they just can't avoid paying, there's still, on the face of it, enough free cash flow cover there to fund a pretty decent dividend, even if in the first half of the numbers we just had, there was a net working capital outflow. So that is the very sort of rigorous test that you really should be doing. And if that looks like hard work, that's why fund managers exist, to do it for you. So conclusions. Pros and cons for equity markets overall. I mean, what's intriguing is that the UK equity market has gone nowhere fast since February. Began to recover in May, June last year, went up like a rocket after Pfizer Monday last November, but has basically paddled sideways for the last 3-4 months as it's tried to work out what's priced in, what's going to happen in terms of the pace of global economic recovery, and whether we're going to get inflation, deflation, or stagflation, because ultimately nobody really knows. So you've still got huge amounts of monetary stimulus on one side, but at some stage that could be withdrawn if inflation starts to get galloping, or at least maybe not be quite so fulsome. Fiscal support's still strong, but government's really, I mean, the UK government's basically bankrupted itself, so it really does need to start doing something about that at some stage, even if you've got a prime minister whose own personal financial affairs are, shall we say, colourful, and certainly fiscal probity doesn't seem to be top of his particular personal priorities. Maybe that spills over into state finances, who knows. Vaccination programs look to be going well in many countries, but equally you can argue that the pace of recovery is uneven in others. And there are some signs that maybe markets have got a bit overconfident, even if some of the bubbliest pockets have recently begun to spring a bit of a leak, whether that's Bitcoin, IPOs, SPACs, meme stocks, or whatever else, the sort of things that generally make you nervous that we're getting a little bit overheated. Equally, there are still signs that there are some pockets of the market that do look very unloved, potentially very cheap, and do offer decent dividend yields. And I think the one thing about dividend yields is that, as Mr. Benjamin Graham here said, Warren Buffett's mentor, they tend to get forgotten when the going looks easy in terms of capital gains. And over the last 12 months or so, you would certainly say that capital gains have actually been relatively easy to find, helped by vaccination programs, fiscal stimulus, and monetary stimulus. During the latter stage of the bull market culminating in 1929, the public acquired a completely different attitude towards the investment merits of common stocks. Why did they turn attention from dividends from asset values and to average earnings and the change in income that was expected? Well, because people were deciding it was all different this time and because it looked easy, basically. Now, I'm not predicting another 1929 style crash, but some of the things that we saw before that have been happening in similar shape and form in the last year or so. And don't forget dividends, they are a key part of total return. And sometimes, as I'm sure Simon will explain, it's not actually the highest yielding stocks that give you the best total returns. It's those who consistently grow their dividends over time, and that's just maths. So that's why dividend investing is particularly important. If you have a company with a share price of £1 and it's paying a dividend of a penny, and over time it grows that dividend by 1 penny a year to 10 pence in 10 years' time, I'd be pretty confident saying the share price still won't be £1, because that's giving you a 10% dividend yield, and that's like picking money up in the street, at least if the business is still as sound as it would suggest that it's capable of increasing its dividend by year. So don't forget dividends, they are important. Yes, capital gains are lovely, but in the end it's dividends and dividend reinvestment that can be the secret sauce going forwards, and dividend growth. So look at that balance sheet, look at that cash flow, look at that P&L, and if it is hard work, you've got some fantastic fund managers out there who'll do it for you, either in equities or indeed in other asset classes, dare I say. And I think on that note, I'm going to say thank you